So you've been hearing about the interest rates hikes, the layoffs, the recession that's possibly coming. Well, don't worry, I got you. Because in this video, I'm going to break down the things you should be thinking about and how to remove the fear and being scared of all this information, interest rate hikes and recession, and how you can be prepared to take advantage of it and come out the other side richer than you were before we went into a recession. Let's get into it. So there's a lot going on in the economy right now. There's a lot going on in everybody's lives. And a lot of it has to do with fear and fear of everything that the news and the media is talking about. And I don't think a lot of people really understand what's going on or how it could affect them either negatively or positively. I can't even say it right. Maybe because just like most people can't think positive right now, it's hard to even say the word positively. But there is a potential that with everything going on, it can affect you positively. So I want to talk about that side because it's not all doom and gloom, but we also need to be prepared for, what all this interest rate hikes and recession talk could potentially mean. So let's just dive into what just recently happened. So depending on when you're listening to this, Fed Jerome Powell just raised interest rates again. And not only did he raise interest rates again, he basically said that we're going to raise interest rates another 1.25 basis points. So this was just this past Wednesday, September 21st, I believe is when they raised interest rates or did that whole meeting, or it was the day before. Anyway, that's not even really important. What's important is, what does this mean? So let's talk about what this means so you can be informed when you're talking with people at work, or you're like, what's going on with the stock market? You're not sitting in the corner like, I don't know what's going on. So don't ask me. So here's what this simply means. When you think about the Fed raising the federal funds rate, which when you look at your credit card statement, or you look at, you ever hear like on your credit card, let's just stick with that. It'll say your interest rate is, 7% plus prime. So that plus prime is controlled by the government for the most part, to keep things simple. So if your interest rate is 7%, when they say plus prime, if prime is 2%, then it'll be 9%. If it's prime is, headed towards where it looks like it's headed, like 6%. So if your interest rate is 7% plus prime, well, you're talking about 7% plus 6%. You're talking about 13%. That's almost double, what the base rate is, if that makes sense. And so what that starts to do, and when you think about it in terms of houses as well, let me go there as well before we talk about what that starts to do. When you think about that in terms of houses as well, what was happening is when the pandemic hit, interest rates were so low at like, 2.25 or 2.9%, under 3%. What it allowed people to do was buy more house, because what happened for the first time, or for a long time in history, is that a house that normally would cost $300,000, you may not have been able to afford that at a 6% interest rate. So you would have to buy a $200,000 house, because at a 6% interest rate, maybe your payment was $3,000. I'm just making up these numbers. Let's just say your payment was $3,000 at a 6% interest rate. Well, when they cut the interest rate in half, basically went down to about 3%, all of a sudden you could now afford, so that $300,000 house you couldn't afford because you could afford a $200,000 house. Well, you now could afford a $400,000 house, and it would still be roughly the same payment as the $200,000 house that you could afford. So you could afford $100,000 more of a house. Because remember, you normally couldn't afford a $300,000 at 6%. You could only afford a $200,000. Well, when the interest rates go lower, not only could you afford the $300,000, but you could afford to pay $100,000 over the asking price. So you could go up to a $400,000 house, or pay over $100,000 for your $300,000 house. I hope that makes sense. You could overpay or just buy a bigger house, and your payments would be about the same as if you had bought the $200,000 house, because that's what interest rates do. Interest rates payments spread out over a long time, mixed with a low interest rate, gives you a low payment. Payments spread out over a long time with a higher interest rate gives you a higher payment, which means you can afford less of a house if you want to bring that payment down. And so interest rates basically allow us to charge things on our credit card. And you're like, I'm only paying an extra 3 pennies for every dollar that I spend. That's not bad. Well, when they raise the rates, it's like it's an extra 6 pennies, right? And then as you spread that out over thousands of dollars, or 6 pennies that compound every single month, if you don't pay off that balance, it becomes a problem, or you think twice about what you can buy, or the things that you buy will keep you in debt a little bit longer. So how does that translate to a recession, economy, poor earnings? Why are people selling their stocks? A couple of things are happening. Number one, if people can't buy, I shouldn't say if people can't buy, if people are buying less than they would, because most big purchases are financed. You think about a car, it's typically financed. You think about a home, it's typically financed. Most people don't just walk in, drop cash for a car, drop cash for a home. If you think about business expansion, you're buying a building, you're buying equipment, you're usually financing that equipment, which is going to allow you to expand your business. Think about a doctor, think about a dentist who's thinking about opening a practice. They need the seats, the dental equipment, the medical equipment. Well, now all of that stuff that normally is financed, you still could finance it, but now your monthly payments are going to be higher on that, making the risk of going into business for yourself higher, making the cost of capital to stay in business higher, because now you got to make more money to pay off that debt because you have a higher payment. If you're buying a car, maybe you will hold on to the used car that you have, or you'll buy less of a car than you were willing to pay for because the interest rate means the payments are going to be higher. Same thing with a house. If you live in a house, you're less likely to move because you typically don't downsize unless you're in your older days. But the majority of people buying houses are young people, people who are expanding their family, etc. And typically you need a bigger house. So even if your house is paid off, you're typically going to go into a bigger house and you're going to acquire new debt, but now you're going to acquire that new debt at a higher interest rate, which means that you go from no payment to a payment, but not just a bigger payment than normal because of the interest rate being higher. And even if you were to go from your current house to a house that is similar price, but you just like this one better, you're going to jump out of your maybe 3% or 4% loan and then get into a 6% loan. So automatically you're paying 2% more, which is going to equate to paying more for the house over 30 years or I should say, paying more money out of pocket for the house. Now, how does this affect people? If you're paying more money for the house, then that means you have less money for groceries, less money for vacation, less money for a new iPhone. And so you're going to start to scale back on things that you don't necessarily need. That's called having discretionary income. You can buy discretionary things like a purse, new shoes, etc. Well, if your discretionary income is decreasing because the interest rate, if you finance a car, a home, or put something on your credit card, mixed with the fact that everything is costing more anyway because of inflation, so you're paying more for it and you're paying more for it if you charge it or finance it, you're going to start to think twice about even buying more things. So if you were to slow down your spending, slow down your buying, and we all as Americans start doing it at the same time, that's what we call a global slowdown, or we start to see slow GDP growth, right? Gross domestic product growth, meaning we stop spending as much money. The US stops importing or exporting as much. Maybe the rest of the world is going through the same thing at the same time. So they're not exporting as much stuff from the US. And so what you have is companies now are selling less and less of their product. Now, I want you to listen to me and pay attention, because this is where it gets important. Because it costs more to buy things or finance things, you stop or don't do it at all. Because you stop, don't do it, or slow down, and we all slow down at the same time, companies sell less products or services. Because they sell less products or services, they start to look at how can they, A, still deliver their numbers to Wall Street, B, how can they survive this slowdown until things pick back up. And so when they start to look at how can we deliver our numbers to Wall Street, meaning we still have to be profitable And how can we survive this slowdown until things pick back up? What we start as business owners and as companies to ask ourselves is, how can we cut costs? And one of the first things, I would say the top two things that a company probably looks at first is, number one, advertising. And so they say, well, if people aren't buying as much, maybe we don't need as big of an advertisement budget because we're advertising when people are slowing down their spending. That's one way. The other way, they might say, no, we need to keep advertising up to make sure our name is out there and people think about us when they do go to buy the product. But do we need as many employees right now? Because, we got 10 people just standing around picking their nose and we're not selling as many products. Maybe we can only do with 5 people. And so here comes the problem. So good news, bad news. Good news is Fed raised interest rates, slows down consumption, slows down spending. Great. Allows the prices to come back down. They don't need to make as much stuff, allows the supply chain to catch up. Good news. Bad news, companies sell less. They start to look at ways to cut costs. They start to look at you guessed it. They start to look at the workers and say, hey, maybe we don't need all of you. And so as companies start to lay off, this is what the world is talking about the self-fulfilling prophecy of a recession coming. So what do you think happens if companies start laying people off? It just refeeds the machine. What machine, Jason Brown? Well, glad you're listening. The machine that says, hey, if these people get laid off, that's more people that have less money to spend. More people that have less money to spend mean they can't buy cars, can't buy houses. You definitely can't get approved for a house without a job or a car. So that helps with inflation because there's less consumption, less spending. Okay. But good news, bad news, it helps with inflation, brings costs down, brings supply and demand into alignment. However, you just lost your job. All right. So I don't know how much good news that really is, but good news for the economy, bad news for you. And so that's pretty much what the Fed is saying indirectly, is that it's going to be bad news for some people. Bad news that you as a young person, may not be able to get that new home for 5 more years or 10 more years, So if you're a newlywed couple still living in your parents' basement, they're like, it's not that bad. You guys can stay there a little bit longer, or you can move into one of these apartments and pay a little bit higher price of rent. But don't sign up for too much of a high price of rent because you might lose your job, right? So, it's kind of this just wheel of fortune that keeps spinning until supply and demand comes in alignment. Now, here's the good news again. You lose your job. The Fed's saying there's so many job openings out there. We can afford to slow the economy down and for a couple of people to lose their jobs, and they can fill in some of these other jobs. Good news, there's other jobs. Bad news, you might not like those jobs, right? You kind of go back to the old days where you're like, I work a job that I hate. But during the pandemic, it was like, everyone's hiring. I can get into all these companies now that I could never get into. And then the reverse happens. They start laying people off. At least that's the forecast of what's going to happen if we continue along this rate hike path, which the Fed said that's what we're pretty much going to do. We're going to keep raising rates until we feel we've hit a level to where unemployment is going to spike. They already know this. We're going to bring supply or demand down so that supply can catch up and let prices catch up. And then we'll feel happy. We'll sit there for a while before we even consider A, stop raising rates, and then B, before we even consider lowering rates again. Now, so that's what this all means. So I hope, number one, I shed some light on what all this means. Now, number two,